What it is, y'all? Now, what's up? Hey, it's your boy Dylan, Day Trader, your favorite day trader. I'm back in this thing with another banger, man. I appreciate y'all tuning in, clicking on my face, clicking on this video, because, you know, we in this series, the Back to the Basics. This is part 3. Back to the Basics, part 3, y'all. Hey, before I get into this video, make sure y'all show me some love, like this thing. If you find this video helpful, subscribe so y'all can be updated when I drop a new video, and also share this video with someone else. Just be selfless and share this video with someone else. Make sure you guys watch this free from distraction. I'm starting from the basics. The basics, man. The basics, baby. So without further ado, let's get into this video, y'all. Let's get into this thing. So this part 3. Back to the basics, part 3. First things first, boom. First thing first, we're talking about financial institutions. So financial institutions are simply companies that engage in the business of dealing with financial and monetary transactions, such as deposits, loans, investments, and currency exchange. So all this saying is we're dealing with businesses that focus on money, currency, which are businesses like what? Companies like what? Like banks, like trust companies, insurance companies, brokerage firms, investment brokers, and so on and so forth. Okay? So the way that these people earn their money is, so, you know, a bank earn their money from the interest that we paying on loans. A brokerage will earn their money from the commissions that is paid from the traders, us. Like when we make a trade, we give the broker a certain amount of commission for using their platform, for allowing us to be able to use their services. Okay, so these people are highly regulated, and they are basically people that help, not people, companies that help drive the economy in a good direction. If we do not have these companies, I don't know what, the financial institution probably go to shit for real. But I don't know what happened, but it definitely won't be a good turnout. Okay, so with these banks, another thing, another gem with these banks, when you ever see the banks, well, not see the banks, but when you ever have a major holiday in a certain country, so like the US, major holidays for us to be Christmas, Thanksgiving, 4th of July, New Year's. Those are the main 4 important holidays that the banks are closed. We know the banks are closed for sure, and we do not trade a currency on a bank's major holiday. So whatever country you're trading, so say you trade in GBP, and whatever holiday it is in that country, and the banks are closed, don't trade, because the market isn't going to do nothing but consolidate. All right. Next, we have hedgers. Hedgers have a primary purpose. Their primary purpose is to use buying and selling instruments to offset or balance our positions. With doing that, it reduces our risk of exposure. Okay, so all that is a fancy way of saying that they take 2 positions. Okay, so with a hedger, you're taking 2 positions. You're taking a buy position, you're taking a sell position, and you would take those 2 positions when you feel that you may be wrong about a trade because news is coming out. So it's normally placed when news is getting ready to hit. So we having news getting ready to hit, like NFP. The NFP come out at 8:30 every Friday, not every Friday, every first Friday of every month. Okay, so today is the 31st. So this Friday is going to be NFP. So when NFP come out, the market spikes. And when news come out, the market spikes. That's every news. But some news make the market move more than others. Okay, so with that being said, if you feel like you may lose a trade, or you feel like you may lose a trade, that's the point blank period. You feel like you may lose a trade, this hedging is when you basically covering your ass. So you put in a buy and a sell. So just in case the market goes up, you good. Either way it goes, you're going to make money. If the market goes up, it goes down, you're still going to make you some money. So that's hedging. Speculators predict trends in the market to make a profit. They are sophisticated risk takers, risk-taking investors with expertise in the market they trade. I threw myself off the way I said that, y'all. So speculators make up about 90% of all trading volume. So speculators, hold on, let me get that water, y'all. Let me get that water. So speculators making about 90% of the trading volume. So if they're making up 90% of the trading volume, that means that they are using a lot of liquidity. So they are using a lot of leverage. So speculating, all they're doing is using short-term position. So a short-term buy position, short-term sell position. Also, this also can be known as scalping. Scalping the market is when you just in a trade for a short period amount of time, or in an investment for a short period of time. So when you're speculating, you're just using a bunch of liquidity or a big lot size to hit whatever goal that you have. So whatever goal that you're trying to get, say if you're trying to get 10 pips, 20 pips, it would normally be nothing more than that. It normally wouldn't be nothing more than like 30 minutes to like an hour in a trade. That'd be like a speculator if you're in Forex terms. So call those scalpers. So they're in a trade for a short amount of time, but they're taking a bunch of risk. So when you're taking a bunch of risk, you will gain a lot, but also you lose a lot. So these people kind of drive the market as well. That's why I say they make up about 90% of all the trading volume. So if you're making up about 90% of all the trading volume, that means that they are risking a lot of money at one time. So they can also move the market in the wrong direction and kind of throw off the balance of the market, which way it's going, because they're people just like we are. No one is 100% in this market. I don't care who they are. If they tell you they're 100% in there, they big cap, man. They big cap. Atlanta Braves cap. That's just how it's going to be. Okay. So sophisticated risk taking. They're just taking a bunch of risk at one time. And if they're wrong and they move the market in the wrong direction, it kind of messes up the balance of it. All right. So that's speculators. So last but not least, we have us. We're the retail traders. We're retail traders, and retail traders are just individual traders who don't trade for a company. So just me, like I don't trade for no company. I'm just me. I'm just trading with my own capital. So that's why, excuse me. So when I'm saying they don't trade for a company, we're using our own capital. Retail traders using their own capital, and institutional traders, they're using a company's capital. So they're trading for a certain company. So they might be like JP Morgan, like the banks. Okay. Whoever else, I can't think of any other companies that have like a trading company or have institutional traders, but those would be the people that are not retail traders, people that trade for a company. So us retail traders, we make up about 6% of the market, and we're the lowest, not the lowest, but we're the least we make up the least amount of the market. All right, so hey y'all, this right here is the end of the basics series. The end of basics, back to the basics series. Hey, appreciate y'all tuning in and clicking every one of these videos in this series, and I hope y'all learned something today. I hope y'all learned something, and I hope y'all can use this knowledge that I'm sharing with you guys. Hey, make sure you guys are staying positive all the time, because when you're negative, it don't do nothing but makes your day worse. All right, so always remember, keep God first. Never stop grinding. Never stop doing what you feel is right. But then the day trader, I'm out this thing, y'all. Love.